So Australian shares are trading up slightly today after global markets lost hundreds of billions of dollars overnight. The dive was prompted by fears the US economy is headed for a recession. Bloomberg reporter and macro strategist Mark Cudmore joins us now live. Hi there, Mark. I bet there's a big sigh of relief in many quarters this morning.
Absolutely. I'm not sure that the turmoil is necessarily over. It is certainly calmer markets today, and we are seeing most equity markets bounce today, see a little bit of recovery. That was kind of expected given just the scale of the losses of the last few days and Monday in particular. So nothing at the moment on Tuesday is going particularly not to plan. But I think that the scale of these moves is still problematic. When you start seeing the topics bounce back by more than 9% in the session, its best daily session since October 2008. And that, if you remember, that was in the middle of the great financial crisis. When you see moves that are so powerful, even if they're positive, what they mean is that they increase the kind of value at risk measures for banks and for funds out there, which means they ultimately must reduce their exposure. And that probably means some more forced selling in the days ahead, even though this is a positive day. So I don't think that overall we've seen the end of this turmoil, though I hope we won't get a day quite as dramatic as yesterday.
No, I'm sure lots of people do. Mark, did anything in particular happen yesterday that's enabled this stability today, or is that just the ebb and flow?
It's mainly the ebb and flow, but it's a very good question. I think a lot of this is like, it was a classic kind of tee up of kind of human psychology of why we get such a dramatic sell-off on a Monday, and then we normally get that turnaround Tuesday. In markets, we refer to this phenomenon as turnaround Tuesday. And in fact, there was such a classic setup that you actually got to sell off in kind of Wednesday, Thursday, Friday into the weekend as people start getting more and more negative. They read all the weekend media that's so panicky. They open Monday going, I must get out of positions, and it just starts snowballing. And then you get a little bit of calmer heads kind of going, hey, what's changed? Why so dramatic? Sure, there are some fundamental drivers to this sell-off, but I think that we've gone from kind of a few weeks ago being completely complacent on the US economy to suddenly assuming a hard landing. And I think that sudden shift is a little bit overdone. Similarly, we've had a few other dynamics. We've been a bit disappointed by the AI bubble. But again, we've known those stocks been expensive for a while. It's not that they've been, massively disappointed. They're just some of the bubble is deflating a little bit. And finally, we did have the Bank of Japan policy misstep last week, where it hiked rates just as it might possibly, for the first time in decades, escape kind of a deflationary stagnating spiral. So that's kind of blown up carry trades out there and therefore risk positions. So I think yesterday it was purely just human psychology calming a little bit. And then as people reassess this week, you're going to expect some more risk reduction. Do we make fresh lows? Hard to say, but it wouldn't surprise me. And some assets haven't yet fully repriced. I think, for example, credit markets probably have more to sell off, and that's where you get the transmission into the real economy.
And governments and reserve banks don't like instability. I mean, the Fed in America and what happened with the employment figures, are the American markets still in a very fragile state, or might they see what we've seen here and in Japan and a bit more stability going through into the night?
I think that given the extraordinary performance of US markets this year and over the last number of years, we've been in a 15-year or maybe 14-year era of American exceptionalism when it comes to markets. They don't look particularly fragile. Yeah, there have been some dramatic losses in recent days, but most people in US stock markets are healthily up for the year. The same can't be said for a lot of Asian markets. And you take, a darling of Asia was the Japanese stock market trade, and that, turned negative for the year yesterday. Because the violent rebound today, it's back positive. But, I'd say that the fragile markets at the moment don't seem to be in the US if you're looking past performance. Now, from here, it's probably true that the AI-focused kind of euphoria probably still has more to come out in US stock markets, where many Asian stock markets are already quite cheap discounted, and therefore they should have less violent sell-offs ahead of us.
As you know, Mark, we've got the rates decision from the RBA later on this afternoon. Are stock market gyrations, if you like, of great concern to the RBA?
They are when they sustain, because they ultimately have a wealth impact and they hit consumer confidence. I don't think central banks anywhere particularly mind if you see the stock market sell off by a few percent, even though it gets big headlines, it gets dramatic. What they're worried about is if you see an ongoing sell off. And I think similarly, they get really worried when markets get very bubbly and kind of trend higher for a sustained period because of that, and then increases the risk of a future correction. So it's the idea of sustained selling is the problematic, or sustained volatility, because both have the same impact of that they reduce consumers' confidence in their wealth that's stored in their savings, and therefore that reduces their propensity to spend, and that becomes its own negative impact on the economy going forward.